questioning Capital One today about its proposed takeover of ING Direct, a deal that will make it the nation's 7th largest bank by assets. There are concerns that getting bigger will increase risk for Capital One and perhaps make it the next Countrywide, say some. Joining us with what's at stake here, Neil Weinberg, editor-in-chief of American Banker, and John Taylor, president and CEO of the National Community Reinvestment Coalition. And on the phone, Josh Steiner, managing director of financials with Hedgeye Risk Management. Welcome to all of you. Mr. Weinberg, you follow this industry very closely. You know what is at stake here. Some say that letting this deal go through might create the next Countrywide. The simple question is, will it? Is there systemic risk at play here?
I don't think this is going to create the next Countrywide, but I think there's certainly some questions here about, among other things, antitrust, the question of whether this is going to create a company which has such a large piece of the credit card market when Capital One also takes over HSBC's credit card division, that you may be creating some additional problems. You know, it also raises some serious policy issues here in that if the federal regulators and the Fed say, no, we're not going to allow any bank this large to do any deals, what does that say of the half-dozen banks that are even larger, that they can never do any deals?
Mr. Taylor, react to what Mr. Weinberg just said there. Your group is very concerned about it. You're afraid that they're effectively, I believe your word, going to loot deposits to buy credit card receivables, securitize them in the manner of a subprime loan, and maybe put taxpayers at risk.
Yeah, I mean, first, let me say, I think Neil has a point on the antitrust issue, and I hope that the Fed listens to that. But secondly, we do think this is very different than than the larger banks buying ING. Some of the other banks that are in play here, Citibank, Wells, Chase, Bank of America. This is, this is very different because, and here's the distinction. Capital One, 76% of its profits actually comes from its credit card business, 76% of its profits. No other major bank in the country has more than 32% of any particular product line as its major source of profits. In fact, when it comes to the other big banks, not one of them has more than 19% of its profits coming from credit cards. This is a credit card company that basically has been using the banking industry as a way of building its credit card and auto lending business line. And because of that, what it's become as a monoline company is it's essentially put all its eggs in one basket where if things go south on the credit card business, that bank is going to collapse. All right,
that's an interesting point. Let me bring in Josh Steiner, who is Managing Director of Financials at Hedgeye Risk Management. Why don't you react to what Mr. Taylor said there? This has been a company that has concentrated its bet in the credit card business, and it has become fundamentally, his word, a monoline. Is that a risk systemically, and two, a risk for investors?
Sure. You know, I think that's an interesting point. I think Capital One's really always been a monoline credit card company. That's actually why they're trying here to diversify. Our concern is more around the fact that Capital One is a credit cycle renormalization story. In other words, you want to buy the stock when delinquencies peak, and you want to sell the stock when delinquencies bottom, and delinquencies are currently at their bottom, and here they are essentially doubling down, financing their HSBC acquisition through ING. So we're really looking at this more through the lens of shareholders over the short and intermediate term basis, and what we don't like about it is the fact that this is just the wrong stage of the cycle to be taking a look at Cap One.
That's very interesting that they're going to use the deposit base and the capital of ING. I want to go back to Mr. Weinberg now to finance the acquisition of these receivables, the credit card business of HSBC. Mr. Weinberg, what is the best argument that Capital One could make in defense of this acquisition?
Well, it's very interesting that the Federal Reserve was asking the executives at Capital One some very specific questions, and this comes under the Dodd-Frank legislation, namely that the Federal Reserve, if they are going to let this deal go through, are supposed to make sure that it does not create another taxpayer bailout in waiting. And to do that, they want to find out what sort of exposure they have to things like the commercial paper market, the securitization market, to make sure that if these markets were to get into serious trouble, control. Would that bring down Capital One, or vice versa? Would Capital One bring down these markets? In which case, of course, federal officials would have to come in and bail out with taxpayer money again.
Fascinating conversation. Neil Weinberg, John Taylor, Josh Steiner.
May I say something on that?
Very quickly. Give you 15 seconds.
Look, but with the acquisition of ING and then HSBC, Capital One will have a 33% share of the securities market for securitized credit cards. That's 33%. When Countrywide failed, it had about 13% of the market, 14% of the share of securities on MBSs. Imagine one company failing, and the securities market for credit cards, 33% of it owned by one company.
Interesting concluding fact. Neil Weinberg, John Taylor, and Josh Steiner, thank you very much.